All right, I would say let's start. Again, a very warm welcome from our side for joining our presentation. And today we are going to give a talk about the art of credit risk modeling within a regulatory framework. Okay, I just read my colleague couldn't join, but he seems to be also he has joined. Okay, I see him. He's here. All right. Yeah, we're going to give a quick or a little talk about credit risk modeling. Why are we going to do that? Because Anastasios, my colleague, and I were both joined around 2 years ago UniCredit or the German branch Hypovereinsbank in the PD modeling team, and yeah, we thought this might be a good chance to share our experience with you, and share what we've done so far. So let me quickly introduce myself, and Anastasios is then following. Before joining Hypovereinsbank 2 years ago, I did a PhD at the TU Munich in empirical finance. I was doing research on investment strategies as capital market anomalies, and before that I did business administration and technology at TU München. And yeah, I came to UniCredit because I like working with models. I like quantitative work, and that's what I had the possibility here to do. And with that, I would now hand over the mic to Anastasios to introduce himself and to the first part of the presentation. Thanks, everyone.
Hello, also from my side. First of all, I would like to say that I'm also very happy to participate in this event. So I will also give a very brief, let's say, description of my background. So we are actually colleagues with Joachim. We belong in the same team. So we are actually members of the probability of default and Pillar 2 unit. And I joined HVB 2 years ago. Before that, I actually was working at the University of Miami in the US as a professor for 2 years. And before that, I also did a PhD in financial economics in the UK. So actually, it is, let's say, a great experience to have joined HVB because the international background that I have, and also all the international experience that someone could gain, could be, let's say, fulfilled and meet all the expectations in this position. So I will not spend any more time with this. So I will already start with the presentation. Before I start with the main points that we want to discuss about the credit risk modeling, let me just give you a very brief overview on, let's say, where the Hypovereinsbank stands right now and why it's important, the models that we try to build, what is their impact. So right now, as you are probably aware, Hypovereinsbank is actually one of the largest banks here in Germany, and it's also a member of the UniCredit group, which has as a center Italy. So right now, actually, the portfolio that is, let's say, more prevalent right now in HVB is especially the corporate one. As you can see here, it's actually the number 2 private sector lender right now in the market. And also, however, there is, let's say, a strong move as well on the retail portfolio, and also in some, let's say, more specialized clients that the bank has. Here in this slide, you can also see some more information regarding the bank. Something additional that I would like to mention is actually that, especially given the fact that Hypovereinsbank is actually the second largest legal entity in the UniCredit group. There are also many different legal entities that are, let's say, on the landscape of Hypovereinsbank, and also these are usually across different parts of Europe. So if we actually move to the next slide, then we can see also in combination with UniCredit Group, and considering also that, where are all the different branches that right now UniCredit Group has is actually located. So having said that, I will just describe briefly what we're going to present today. So I think before we go into detail on how some modeling activities could take place and what is, let's say, the general procedure that is being followed in order to develop especially a probability of default model, I think it's very useful to give you a background on the current regulation that is in place, and also maybe give you some more historical information regarding the evolution of the regulation during the last years. I'm quite sure that given your interest, some of these regulations or terminology that I'm going to use, you are already familiar with it. So I will begin with this, and then we're going to continue with the actual modeling part, and also provide to you, let's say, some general frameworks that are usually followed from all the banks in order to try to evaluate and develop the best possible model. So then, as I was mentioning before, let me just start by providing the, let's say, the historical aspect of the regulations that are actually right now in place. So probably you have already heard what about the Basel 1, Basel 2, Basel 3, and actually also quite soon we're going to have Basel 4 as well. So starting from the beginning, I would say that Basel 1 created or tried to develop a foundation that all the banks would need to meet as a minimum requirement in order to establish the fact that they will have as least risky portfolio as possible. So the main aim of Basel 1 was actually to try to ensure an adequate equity base to avoid any kind of, let's say, problems with the portfolios that are in place. And for these reasons, for this reason, it was very important for the banks, and so was actually imposed from this regulation that the institution should hold at least 8% of Tier 1 capital. So this was actually the very first step in order to ensure that the banks would try to be as safe as possible for the investors, and of course for all of us who are the depositors of our money to the banks. Also, something very important that was introduced with this regulation is actually related to the risk-weighted assets. As we can see also from the slide, the weight or the risk weight that is being placed into different facilities, it really depends on the type of facilities. So for example, if there is a loan from a central bank or some cash, then you can imagine, of course, that this can have a very, very low risk weight. So in this case, for example, we mentioned something close to zero. And of course, when we have more complex financial instruments, then the risk weight could increase considerably. So having already set these foundations, since more steps needed to be taken also from the regulatory point of view, then the Basel II framework was introduced. So the Basel II framework actually is also a very important one because it introduces 3 different pillars which needed to be considered in any kind of risk management activities that are being applied from the banks. For example, Pillar 1 is introducing the possibility that the banks could use internal rating approaches in order to try to develop specific models and then try to evaluate the riskiness of their portfolio in comparison to the standardized approach that can also be applied. Later, we're going also to discuss how these different choices of having an internal rating-based approach could have an impact on the choices of the bank, and of course also to the capital requirements that the bank will have. The second one, the pillar 2, is actually related mostly to the internal risk calculation. So in this case, actually, additionally to the main risks that are always considered from the bank, you can think like credit risk, operational risk, market risk. The banks should also try to consider any kind of additional risk types that might be relevant to them. So, for example, depending on the portfolios of the banks, a bank could also be exposed to a real estate risk, for example, if it has a portfolio that is relevant. This is just an example. And then also there was a pillar 3, which actually was introduced in order to try to have and increase the transparency in all the processes. After Basel II, although it was actually quite successful, some further amendments need to be made, and these were actually focusing mostly on bank liquidity. So especially given the recent experience that we have from the financial crisis in 2008, and also, of course, right now with the whole situation that we all experience with the coronavirus crisis. You can imagine that the liquidity is actually a very important aspect that the bank is always considering in order to try to evaluate the risk that is exposed. And finally, something that is being trying to be introduced actually from all the banks, and there are certain deadlines that need to be met, is regarding the Basel IV, where the aim is actually to try to limit the variability of internal risk models. So this would actually make, let's say, the comparison of the risk between different financial institutions to be much easier. That's also, I think, a very important advantage that this new regulation would actually introduce. If we go then to the next slide, actually here, we provide a recap of the Basel II, because like I mentioned, there were many different components that were introduced there. So the only thing that I would like to mention additionally to what I was referring to before is that especially with the Pillar 2, it's given the possibility to the regulators to intervene at an early stage when it seems that the capital of the bank is actually decreasing. Then this allows for, let's say, more time flexibility in order for the bank, in comparison with the regulators, to take the most appropriate steps to reduce once again the risk that is relevant, and therefore increase once again the capital levels that the bank needs to have. So if we move to the next slide, I would like to, let's say, deep dive a little bit more on the different approaches that a bank could use in order to try to evaluate its risk. As I mentioned at the beginning, we have actually the standardized approach, which is, let's say, the most simplistic one. So it's very easy to be implemented, and there are not many steps that need to be taken. However, as we can see from this graph, if such a approach is chosen, then the capital requirements, which are presented here in the y-axis of the graph, are usually much higher. So there is a trade-off here, as although in terms of implementation it's much easier, the capital requirement is much higher, and therefore you can imagine that for especially if this kind of approach is being chosen for large portfolios, this could not only increase the capital requirements of the bank, but also have an immediate effect on the competitiveness of the bank. Because of course then this capital would not be available to be invested. Then we have also the IRB foundation approach. So there are some weights that are introduced which depend on the different risk internal rating procedures that exist. There are some LGDs that are given from the regulator, and also there is an approval that is needed once again from the regulator. So in comparison to the standardized approach, here there is the need for let's say a higher effort, since a model needs to be developed in order to calculate the risk weights. So this model will be developed from the bank itself. But this kind of let's say effort is compensated from the fact that usually these models lead to lower capital requirements. And finally, the last approach is the IRB advanced. So in this case, I would say the main difference in comparison to the IRB foundation is the fact that also the LGDs are estimated internally. So in this case, also there are models in order to evaluate not only the PD, but also the LGD. So I think this slide actually gives a very good overview of the different approaches. And now my colleague Joachim is going to continue and deep dive a little bit more on the calculation of the risk, especially in terms of probability of default.
Yes, exactly. Thanks, Anastasios. So that was basically the regulatory part of the presentation which Anastasios gave, and I'm now going to give more the fun part, actually the modeling part. Yeah, but maybe let me quickly give you some kind of feeling for what having an internal rating model actually means. So imagine you have 100 customers and 20 of those customers are bad customers. They will go into default within the next year, and 80 of the customers are good customers, which will not go into default. So to distinguish a good model from a bad model, we can use the Gini coefficient, which is based on the Lorenz curve, which you might know from your economics course about wealth inequality. But we can also use it to determine if a model has a high discriminatory power or not. So imagine we have just 100 random cases, and if you take the first 10 cases, you have 2 defaults and 8 non-defaults, and 2 out of 20 defaults are 10%, and 8 out of 80 non-defaults are also 10%. So you would go here 10% on the axis of the bad risks, 10% on the axis of the good risks, and you would add in a 45-degree angle. And on average, if you take another 10 and another 10, you would have the straight line. So you would have no discriminatory power at all. If you have now a model which can distinguish good and bad risks better, then you have in your first group, as in this example here, 6 cases of defaults and 4 cases of non-defaults. So 6 out of 20 are approximately 30%, 4 out of 80 are approximately 5%. So you end up here at this point. And you do this for the other groups as well. And so you end up basically at a curve like this. And in this case, you have a Gini coefficient of 50, which is the area between these two lines. I'm sorry, my mouse always vanishes. The area between these two lines and the triangle. So we have a Gini of 50% in this case. So yeah, so it makes sense to have a model here to distinguish between good and bad risks, and but it's not just because you have fun in modeling, but actually has also quite a bit impact on the bank itself. And the impact goes basically this way. If you have a model with a bad Gini, then you have more non-performing exposures, so more non-performing loans, which means you have higher losses. For each loan, you need to put some money aside. This is called loan loss provision, basically as a security for the loan. And if you have higher losses, then you need to put away a higher amount of money for each credit. And that has a direct impact on your profit and loss statement. So you have lower profits and you fall behind the competition. In addition, higher losses means you have higher restructuring costs. This also means you have less money for future investment and you again will fall behind competition. So here you can see that actually having a good model is really, really important for a bank, to be able to keep up with the competition. So we have basically different phases in modeling. The first phase here is the data extraction. I would say, I mean, besides the fact that you want to have a model, so this is the most important step, because without data, without good high quality data, you cannot do modeling. In the second step, then you try to figure out, okay, which variables give me a predictive power for future defaults. In the third step, you combine these variables, and in the fourth step, you validate it. Of course, in reality, it's not like one after the other, but you validate your data, you validate already your statistical analysis, then you need again data. So it's more like an iterative process, like everything in parallel. I think for the sake of time, I'm going to say only a very few words on this slides. So in the past, basically, the credit officers had a good knowledge. They still have a very good knowledge, and they said, okay, I think this customer, with the numbers I have from the customer, and I know the customer, okay, I believe the customer has this or that probability to default. And a little bit later, there was already some statistical support, let's say, but still the experts, the senior risk managers, they have a high influence on the outcome of the rating. And in the modern times in which we are nowadays, actually the influence of persons, of people, is quite limited to the outcome of the rating. There's still some possibility to influence the rating, but it's much lower than in the past. And of course, you can imagine not everyone likes that, but I mean, that's how the world goes, basically. So how would we start developing a model? The first step would always be, okay, select your rating segment. So it would make sense to have a homogeneous group of customers, and for this homogeneous group, you're going to try to build a model. So for HVB, it's, for example, we have a German middle market segment, which is companies with a turnover between 5 and 500 million. We have small business customer which have a turnover below 5 million. We have private individuals. We have a separate segment for commercial real estate, because real estate is, of course, different to other normal regular companies. And we have the segment other, which includes leverage, finance, buyouts, shipping. So this is what we are covering as HVB. The holding company, like the group, they are covering group multinational companies, banks, and other exposures. So after we have selected our rating segment, you have different modules you could use. So you could a so-called quantitative module you could use it, which contains financial information. You could search your demographic information, which does not make sense or not a lot of sense for companies, but for private individuals. You could use qualitative module, behavioral, or external rating. So financial information is, for example, balance sheet figures. Socio-demographic would be something like age, income. Qualitative would be quality of the management of a company, or is the customer and the supplier base diverse, or is it depending on one customer or supplier? Behavioral would be which we can observe directly in the bank. So because we have the account movements, so has there been overdrawn month in the last month? Was there a return debit note? So a Lastschriftrückgabe in German. Or external ratings, which could be something like credit bureau. So in Germany, this would be the company Schufa, or ratings from Fitch or Moody's. So the starting point would be we have a long list for each module of variables. This is called long list. And in a univariate analysis, we try to reduce these numbers successively. So we have a look which of these variables has a SOMAS-D value above 10% with regard to the default, and the result here is the medium list. Then we do a multivariate analysis. So basically, we compare variables using pairwise correlation, and when variables have a correlation above 50%, we drop the variables out, or one of the variables. We keep one, and the other one is going to be dropped. Then we do a stepwise logistic regression. So basically, we use all our significant variables, and we put them stepwise into a logistic regression. And if a variable is insignificant, then we drop it again. Of course, we do some multicollinearity checks, and then there's some optional stuff which I would skip for now. So let's say we chose the mid-corporate segment, and we chose a qualitative, a quantitative, and a behavioral module. And then we have for each of these modules our short list of variables. And here we do a logit regression to calculate a module score. And once we have a module score for each of these modules, we again do a logistic regression, and we calculate a model, an overall model score for each customer. And now we are already at the last step. Once we have a final module score for each customer, we have to translate this score into actually a probability of default. And how are we going to do that? First of all, we create something which is called central tendency. This is the long-term default rate, because usually we have a longer history of defaults than we have a history of development samples. So we have the defaults for a longer time than we have the variables which you can use to model. So we calculate this long-term default rate, and then we create buckets for each of the scores, and we see, okay, how big are the defaults for each of these buckets, and with that we estimate an alpha and a beta, and then we shift. Again, we estimate a tau based on these central tendency, long-term default rate, and with this we shift basically our estimation towards this long-term default rate. And then it's just a transformation to calculate the PT. Okay, basically that's it. So, of course, there's a lot of stuff which is a lot of more stuff which is going on, but that's a quick overview for now. If you have questions, of course, you can write us an email And if you have questions now, please feel free to ask in the questions section. I think it should be possible. I'm not sure. Or I just unmute all participants. So maybe if you like, you can ask questions directly. One question to the support from the marketing and career service. Can we post somewhere for everyone our email addresses? So in case there are some questions. Okay, I see it here. So if you like to know more also about internships, working student positions, please feel free to contact me. I just posted my email address. Yeah, it would be nice to hear from you. Thanks for joining the call. It was very short, unfortunately. I would like to have spent more time, but that's how it goes. 30 minutes. So yeah, thanks a lot again for joining. I hope you had some fun, and hope you find it as interesting as we do.
Thank you very much also from my side.